The announcement in November from Zillow to shutter its home buying business quite literally left the door wide open for Opendoor Technologies and other iBuyers. But year to date, Opendoor Technologies stock is down close to 42%. Is there an opportunity here to get in on the ground level of an industry revolutionizing business? Or will Opendoor's fate be the same as Zillow offers? That's what we're going to dive into in this video. You're watching More Money. Let's get it. Guys, the iBuying business is very interesting to me because as someone who has bought and sold a few homes in my lifetime, I definitely would have appreciated a smoother process. That's why I believe services like Opendoor and Redfin now are so exciting because you can get an immediate cash offer on your house and in some cases generate net proceeds in excess to what you would have generated had you listed in a more traditional agent method. And I'm not alone in this feeling, as it looks like the vast majority of sellers cite the convenience and certainty as primary reasons to sell to Opendoor. And it also looks like many of these same people are also contingent buyers who need to unlock the equity in their current homes in order to close on the next one. So despite what the market pundits are saying after Zillow offers shut down their home segment, there is a real business case for the iBuying market to exist. I truly believe that. And in general, real estate is almost as large as the auto and foods markets combined. So there's lots of room here for innovation, especially since the industry is largely fragmented with over 2 million agents. But I have to add, as much as Opendoor and Redfin may disagree with me, I think the iBuyers market will not take the whole market. They will likely only appeal to the convenience market, which may just be 5% of the overall real estate market. Most people, I would imagine, would want to realize the full value of their homes. So although slides like that may make the opportunity look amazing, let's cut the bull Opendoor and be honest to the investors. I personally think that the real benefit here with iBuying is the convenience factor of not having to shape up your home to sell it and having a flexible closing date so that you can set everything up accordingly to be able to move into your new house with no issues. And here's where you can generate significant savings, as the time required and the cost required to sell a home could be substantial as shown here, albeit this does seem like an outlier example. Once again, guys, I'm seeing a trend here of management over embellishing in their presentation. Strike to Opendoor. So how exactly is Opendoor able to offer the seller a competitive price? It looks like it comes down to their ability to combine market data with the proprietary data, which includes seller inputted information. Now I have to pause right there because that's exactly the same type of thing that was mentioned by Zillow's offers before they took large losses and mentioned that they're about to lay off a quarter of their workforce. So it'd be foolish to believe that there isn't some real company destroying inherent risk in the iBuying business model. That being said, Opendoor is scaling up and opening up new markets. Their current playbook takes them to approximately $50 billion in revenues and 4% market share. And I think that's more reasonable and closer to my estimate of the market being only approximately 5%. They're saying 4%, so that's really good. So let's take back one of those strikes. Opendoor, you're back to just one strike. Now, of course, that's a huge leap from where they are currently, as they are less than 1% of the industry. In my model for Opendoor, which you can grab from the description below, for free, might I add, just please remember to smash that like button as a thank you for the work done. I'm estimating that they will achieve half of their revenue growth or achieve 2% market share by 2030. And that seems quite reasonable, as they've guided to achieve revenue in the approximate $7 billion area by the end of 2021. And they're proving out their business model as they have achieved a 4% contribution margin in established regions like Phoenix. Now note that this is an older chart. Here's what the overall contribution margin has looked like in 2021. They have absolutely been crushing it. And they're currently operating above their long-term target for a total contribution margin of between 7 and 9%. You'll note that in my model, which forecasts out earnings to 2030, I am not giving them credit for any additional contribution margin because they have reiterated that they are confident in their ability to manage contribution margins in that 4 to 6% area, and longer term they expect to consistently reach 7 to 9%. So this could be one of those under promise and over deliver situations, but it could also very well signal that the contribution margins are expected to decline. You know, now that I've been making more and more videos, you guys are really getting to know me better and the way that I value companies. So my assumption is that contribution margins will come down from where they are today. That being said, they are looking to increase their sustainable contribution margins with additional services such as home warranties, remodeling, home insurance, and moving services, all which I believe are quite valuable. This also does reduce some of the inherent risk in the business as they are looking to diversify their revenue by having long-term unit margin composition of approximately 50-50 with the sale gross margin and ancillary services, which is similar to the trade-in business models of Carvana and AutoNation. Now, in addition to the one glaring downside risk that I mentioned being the inability for the system to price homes accurately, which is what took down Zillow offers, there's another inherent risk in this business model. And that risk is inventory risk, or the time between when they purchase a home and resell it. They have spoken to this risk because analysts are bringing it up by mentioning that the average hold time, which was between 3 and 4 months, is much lower than the average to fix and flip a rental unit is. I think it's weird and a bit misleading that they're putting non-performing loans, home builder homes, and performing mortgages into the chart, as all those parties have much higher down payments to absorb losses than Opendoor would have. So once again, trying to make yourself look better with something a tad misleading. You're now back to strike two, Opendoor presentation maker. And I mean, I've worked in investor relations, I've built these presentation decks, I'm on to you. Holding the average home for just 3 or 4 months is a great way to mitigate that risk, especially when you're looking in the context with the average quarter-over-quarter price change for residential real estate prices in the US, because it shows that there was only ever one quarter where prices dropped more than 3% since 1975. But I must warn you, the reason why the 2008 credit crisis happened was because purchases of collateralized debt obligations or mortgage-backed securities were looking at historical payment histories of mortgages and movements of home prices while failing to acknowledge that the past experience is not necessarily a good predictor of future performance. I don't know what the future will look like, but I most certainly will agree that there will be trouble in the housing market, especially since it's been up so much in the past 10 years. You can absolutely see quarter over quarter declines of greater than 3%. And that's especially a greater risk now as we're looking at potential interest rate increases in 2022 as inflation has just hit a 39-year high. So is the year-to-date share price decline of Opendoor Technologies of 42% warranted? I think you can make a case for it as investors are waking up to the possibility that these companies can blow up. That being said, I am valuing the company at a whopping $8 per share with a pretty high multiple, in my opinion, of 20 times earnings. Compared with the current share price of approximately $15 a share, I don't think this is an opportunity that I'll be considering at the current valuation. It's just not a high enough margin of safety, and I don't know about the long-term sustainability of the business. And look, I might just not be smart enough to understand this opportunity, and so I could potentially be making a mistake of omission, but I'd rather do that than make a mistake of commission. Now, since we chatted a lot about Zillow in this video, check out my series on Zillow. Since the share price dropped by over 50%, could the remaining businesses be significantly undervalued? You can get to that video by clicking right here.